Before we get cracking, if you could please go to your app. We have a poll question for you, and we'd love you to answer it. So please go to your app and answer the following question. The tokenization of bond markets is A, a pipe dream, B, the next step for capital markets, and C, a solution looking for a problem. Whilst you're pondering that, we are going to get started with some introductions. So I'd like to ask the panel to please briefly introduce yourselves, keep the marketing to a minimum, obviously, and answer this fun question. I think it's a fun question. If there are any market structure inefficiencies today, who is losing out? Can we start with Steve?
Thank you, Eva. It's great to be working with you again.
It's nice to be doing panels again, yeah.
Before I went into fixed income markets, I did FX. The last panel I was on with Eva was about, what, 10 years ago?
Yeah.
Cool, that's on the spot. So are there any inefficiencies in the market?
Yeah, and who's losing out as a result?
Do you want me to help you out?
There's inefficiencies everywhere, you know, and there's obviously when we. So this panel's about digitalisation. So I guess digitalisation to us at TransFICC really is about automating trading. That's how we think. So obviously, you know, the market is going electronic. We've got lots of different electronic trading venues where you can trade bonds, swaps, you know, repos, etc. But what we're looking to do and help our customers is to automate that trading process. A lot of the trades being done on those platforms at the moment being entered by humans and keypads, etc.
Manually.
Manually. So that is going to change, and it's going to change more rapidly. So where are the inefficiencies at the moment? I mean, they're sort of everywhere. I mean, so it is that manual input of orders, and obviously, you know, fixed income is not the same as equities or FX, very different market, and we can talk about why. But there certainly are inefficiencies at the moment at a manual level. There's also efficiencies with, obviously, trade reporting, issuance of bonds. I mean, there's, you know, it's like almost where do you start? And I think the job of automating is trying to break the problem down or the workflow down from issuance to secondary trading to, you know, how things get booked and even how they, you know, retail players take part in the market. That is breaking the problems down into step-by-step steps. So we could go on, but yeah, I'll pass over to my colleagues.
Do you want to briefly introduce yourself as well?
Oh, yeah. So, yeah, Steve Toland with TransFICC. I'm one of the co-founders, and what we focus on is really helping our customers trade in fixed income markets, both with connectivity and helping build automation tools.
Thank you. Etay?
Thank you, Eva, and good morning, everyone. My name is Etay Katz. I'm head of digital assets at Ashurst, and 24 years of my life have been spent in financial regulation, the last 7 of which have been focused on what I would term digital transformation of capital markets and financial markets. And pleasure to be here. To the question, yeah, tricky question when I heard it for the first time. However, I mean, thinking about it plainly, the main beneficiaries of closing down on inefficiencies, in my view, would be the issuers themselves. I mean, those are the customers. Those are people who are coming to the capital markets to issue the instruments, and the consequential trail of inefficiencies always hurts the main customer in that market. So that is my observation on that. But of course, you know, this is, you know, there's such multiplicity of people involved in the chain in financial and capital markets that every small little error, every small little inefficiency then gets blown out and spread and syndicated ultimately. So yeah, that's my take on it.
Thank you. You had time to think about it, so thank you. Carl?
My name's Carl James. I work at S&P. I'm responsible for fixed income and for municipals. For those that know me, they know that this is my first and last non-trading job. My background is in trading. To answer your question, it's multi-layered and multi-dimensional, but at the highest hierarchical level, it's all of us who, you know, mums and dads, anyone that invests in capital markets, you know, to have a well-functioning capital market structure benefits us all. It's a societal good. you know, there's too many layers and too many dimensions to answer that question really with any real sort of depth.
Next, I'm going to ask, you know, who's making money out of inefficiencies? Dan will be in trouble. So thank you so much for the introductions. We're going to get drill down to all of those topics in a little while, but I'd like to look at the results of the poll question. Thank you for your votes, for those of you who voted. I don't know if you can see it on the screen, but the results are an overwhelming nod to B, which is the next step for capital markets. 68.5% of you said that this, 69% of you said that this is what tokenization is. Less than 10% of you think it's a pipe dream, and 22% think it's a solution looking for a problem. So would you guys like to address this same question and sort of talk about what digitization means for you, whether it's electronification or whether it's tokenization, moving into a kind of digital world? Who'd like to kick off?
Sure. Thank you. So, first of all, I'm encouraged by the response from our audience because I'm sure if the question was asked in last year or the year before, you'd get more pessimistic answers. And for me, you know, having been involved in some of the groundbreaking transaction with my firm and going through the journey, which is quite difficult, let's face it, innovating is not easy, right? Let's not fool ourselves. You know, this is, you know, we're taking a process that has been honed for 60, 70 years, and, you know, most people would say it kind of works for them. And we're trying to not turn it upside down, but we're trying to change a lot of components, interaction between market participants, and potentially, this is not to insult anyone in the audience, eliminate some participants, eliminate some processes and some intermediation processes. So this is not easy, right? We're not in that sort of bracket. But the trophy, which links to scale, going back to what the panel before us was talking about, you know, is it lifting, is it not lifting, is it hovering, will it happen, will it not? You know, those questions are, of course, very valid questions, but the benefits of the blockchain technology, which are now, I think, achieving complete consensus that they have incredible benefits to transform the market, the benefits are only achieved when adoption and scale are at a certain level. So we are in this sort of got to be brave phase where some of you are, you know, investing hundreds of millions of dollars in trying to prove and trying to actually, you know, achieve success commercially with scaling. And some of you are taking a sit back and saying, well, you know, we joined this when you guys are ready for us. And that's fine because, you know, we all have trajectory and targets to meet. So I think, you know, this train has definitely left the station, okay, for me, and definitely reflected by what I've been doing in the last 6-7 years and, you know, how market participants are looking at it and how much effort they are throwing at it. The question is now how quickly we can get sort of on that trajectory of incremental phasing. And you know, it's not going to be a big bang. There's going to be transition. We have trillions of dollars of securities sitting on legacy systems in legacy digital form, etc. We need to bridge that gap. So it's going to be a process that takes time, but requires all of you in the audience to actually harness themselves and actually be optimistic rather than pessimistic. And I find more optimism, which I'm pleased about.
So
Go for it, Carl.
There's a book called What's Our Problem by Tim Urban, and within that he writes about if you frame human history as a 1,000-page book, each page is 250 years, okay? So on page 992 to 993 is the Romans. And what you see is that he talks about the speed of innovation gets quicker and quicker. So if you think about the lives of people from page 0 to page 999, not much changed. So I've written this down, so I need to go. So medicine, for example, you'd essentially be hammers and chisel between page 1 and page 999.
Penicillin, that was the trick. Penicillin, yeah.
Well, page 1,000, which we've just left. Yeah, you've got penicillin and chemo and all the rest of it. Data. Well, data essentially was people telling stories. We then went to the stone tablets, and now we're in the cloud. Plumbing. Think about plumbing. Between page 1 and page 999, and I'm sorry to say this for everyone, but you're essentially defecating in a bucket.
You didn't see that one coming, I bet.
On page 1000, you've got these wonderful Japanese toilets that sort of spray water everywhere and look after you very nicely. We're now on page 1001, okay? And the difference between page 1000 and page 1001, where we are now, is going to be exponentially different. So then if we move the lens in to our industry and what we're doing now, we can see that pace of innovation, that evolutionary change accelerating and accelerating. And we talked earlier, and I agree with you, it's a very positive, and I can see people out there, I can see you, Spencer, you know, you've got innovation, Steve, you're doing innovation, you know, there's loads of people out there doing innovative things, whether it works or not, who knows, but they're trying to do something, they're trying to change things for the better and drive forward. So actually, there's a lot of good things that are going on, and you know, the utilization of blockchain is one of them, and I personally am sold. You know, for me, the trajectory is set. It's just a question of when it's adopted, which is to your point, standards and mass adoption.
Thank you, Steve. What does it mean to you?
I'm not quite sure how I can follow that, actually. I do know what I did wrong, is I wanted to sit next to you, Carl, and crib your notes. Actually, I made a mistake there. So obviously, the problem that we're trying to solve is obviously secondary market trading. And a lot of what we're trying to do is about throughput and speed of messages. That's the problem we're dealing with. So we're not really looking at tokenization or blockchain technologies per se, because they're not particularly fast for the problem that we're trying to solve. But it's definitely going to come. And as we spoke earlier, you know, that train has left the station. What we hope we will enable is, because we do some plumbing, okay, not the Japanese toilet plumbing, but we do plumbing. The problem partly that we're trying to solve is helping with mass adoption. You need standardization, and you need markets to adopt, you know, tokenization or issuance, et cetera, and people need to access, and the market needs to move there quickly. And you know, it's no good having a new standard, okay, and only one guy is using it. You know, you need mass market adoption. So trying to put the plumbing and the pipes together so people can access, you know, bonds that are on the blockchain is how we're approaching the problem. But it's definitely going to come.
But, sorry, can I just say, let's not forget, and this is to your point as well, I really like this line. We have Stone Age emotions, medieval institutions, and godlike technology. And if you frame all that, there are people that have, you know, Stone Age emotions, and they're grasping on to the Post-it note and the crayon that they're doing their job with. Maybe they might, if they're really whizzy, go to an Excel spreadsheet. So there are people that hang on to this thing. I mean, look, I run the primary market stuff. There is a solution, standardized, stable platform that allows issuers, to, you know, and banks and investors to go backwards and forwards. And it's about understanding that mass adoption. It's all available. And it's just how do we get people to buy into that?
Sorry, just at this point, you know, you mentioned, you sort of almost mentioned incentives, Carl, you know, of like being, you know, what is it that drives people, who's driving innovation and who's sort of clinging on to the things that they're using today. So can we talk a little bit about that, of what it is setup that we currently have? Does that encourage innovation, or does it incentivize holding on to the status quo?
Well, partly it's generational. Look, I started trading on the floor of the stock exchange, and there were people I knew when it went screen-based trading, because obviously you were trading on the floor on the Friday, and then it literally was big bang on the Monday, screen-based trading. 2 weeks later, those people had no idea what the hell was going on, and they left the industry. They couldn't adapt. And if you can't adapt, you're dead.
And do you think that's going to happen today, or you know, with this kind of?
Well, the second point is the younger people that are coming through. They are much more au fait with the utilization of technology and how data manifests itself. They understand it. what's the book? Oh yeah, there's a really good new book by Jonathan Haidt called The Anxious Generation. It talks about since 2012 how the youngsters have been using iPads, iPhones, all the rest of it. And there's a bit of a parallel to that. They're so used to it, and you can see them. Most youngsters can program, you know. And I think if you ask people my age, they can say, yeah, I can turn on to BBC Two. You know, because that's what they think, you know, getting a program is. So I think there's a generational thing in there, but I think the technology is getting better and better and better and more user-friendly.
Yeah.
Incentives.
Yeah, incentives. I thought about incentives as Carl was making his last remarks, but I thought that would be your next question. Incentives. Okay, look, I mean, let's talk bluntly. First incentive, can it make me more money? Okay. It's an easy one. It's one that normally with innovation of this sort, transforming innovation, is a multi-layered, loaded question, okay? So it's not as easy as 2 + 3, because if it was, then everyone would have gotten hold of it and done it like years ago. I mean, we are undoubtedly capable in this room of creating a quicker transformation onto DLT based infrastructure and capital markets. But we don't have the right incentives in terms of making more money. Are the policymakers doing enough to kind of chip in? I think they are increasingly seeing that if they're not actually participating more actively in the process, and take a look at most of the DLT bonds, digital bonds issuances, they are mostly sovereigns. Why is it? Because, you know, the normal sort of issues in the market, like, you know, big car manufacturers say, well, you know, market works for us at a minute. Like, you know, we don't want to go through the hassle of that. Liquidity is not there, all that.
And there is risk, right? The risk of unknown, risk of... The
risk of unknown is much less than the risk of doing nothing, you know, because the market at the moment is not risk-free. You know, the risk resulting from reconciliation in the market, from multiplicity of intermediation, is much higher than any technological risk that will result from embedding distributed ledger technology, in my view at least. So I think policymakers are playing an increasingly important role. Is regulation and law the barrier to transformation? The answer is categorically no. And we have proven it with a number of groundbreaking transactions without facilitating legislation. We've done it, okay? Why? Because we carved in the stone, and, you know, we can do that as human beings, you know, we can do that. It's hard, and it takes a while. Will it help to quicken the pace? Yes, absolutely. But we shouldn't sit there and say, you know, no, we've got these challenges and those are barriers, and until those are sorted, we're not doing anything. That's not really what's going on in practice. So what is the you know, it's an incentive question, but what is the major barrier? It's the human sort of state of mind, I think, and we're improving in that. So we're making some good strides in a positive way, but let's not wait for someone to kind of sort it out for us, because it ain't gonna happen.
I'll go a slightly different way. So the, you know, obviously we're working primarily with banks, but with some large buy sides, etc. You know, we're saying to them they should automate. I think there is a lot of people who work at banks who have no incentive to change, you know, because status quo works, and it's the risk of change is too great. They have compliance people, you know, there's annual bonuses, you know, it's just too...
Sticking your head above the, it just, you know, you could get shot.
So I think there's two approaches to solving that problem for us. One is to try and break down the technology problem into small-sized parts, you know, and so, you know, this is not going to be a big bang. You can implement this technology in modular small pieces. And then the other thing that will change things, I actually don't think, controversially, I don't think regulation helps markets change. I think competition does. So I think the banks should be in fear of God of Citadel and Jane Street, who are, you know, that are looking to come into the fixed income market in the way they did with the US equity markets, and we saw in the foreign exchange market. They are rapidly gearing up and spending money. And that is the threat that will force, you know, certainly banks and some buy sides to change and automate.
So before we sort of zoom out again, let's just zoom in a little bit more and sort of talk about what's not working today in the market. What are the bits that need fixing, you know, that would benefit the most from automation or digitization? Manual inputs, I'll get the ball rolling with that. Any others? Any other areas that you think need fixing urgently?
Again, it's so multi-dimensional and so multi-layered, it's almost impossible to answer that question. I think what I would say, though, is where there is inefficiency or where a vacuum exists, the humans who are the best species at adapting will find a way. So I was thinking about this the other day. You know, when I was a kid, the only way of seeing anything sensible would be to go to the cinema. Well, then what happened was Blockbuster, say, came along, and you could actually go and choose the film you wanted to see, and you could watch it when you wanted in your own home. And then CDs came along, so that it was easier to produce those. So again, you could even carry them around and watch them on the tube or whatever. And then Netflix decided they could download it, and you could watch it and all the rest of it. And then now what you've got, and all of those are very passive, and now you've got TikTok and YouTube. So actually you can become consumer and producer. So these are all adaptations in that particular industry, and we will do exactly the same. So there are multiple inefficiencies that I can go to.
Please pick one, just one.
All right, but specifically for me, the DeFi world will go first to private markets, because the amount of work you have to do in the legals to identify KYC, they have to go on various different platforms. But if you utilize blockchain, it collapses that down. So that would be one inefficiency. I'm not sure I answered it very well.
Thank you. No, that works for me very well. Just before we move on, I'd like to encourage everyone to please send in questions. We would like to, be useful to you. So please send the questions that you would like us to answer, and send them in quick, because we only have 20 minutes left. Sorry, Etay.
Inefficiencies. I'm glad Carl went first with that question, at the risk of upsetting too many people. For me, I mean, I'm turning this slightly on its head because I've become very familiar with the gains you can get by adopting distributed ledger technology. And for me, it's about the data, the definitive data of ownership of securities in this market. This is not just important for me to know that I own security X and have confidence in the integrity of the record, but it's also about other people having that confidence. It's also about the issuer being able to communicate with the security holders and get them to vote or get them to express an opinion in a way that is more friendly and more productive than the processes that exist at the moment. I'm not living and breathing the capital markets every single day in a scaled way. Because I'm focusing on these sort of long-taking projects. But that is, for me, a major transformation to how people think. The data about ownership and the single source of data about ownership, for me, is absolute transformation. And
so to flip that back to the inefficiency, do you think there are issues around that at the moment?
Huge issues. Because we have multiple intermediaries that are interacting in the market. And if you look at the classic cycle from primary market to secondary market to repo, how people get assurances about, the sort of the provenance of ownership, and, is the cash there, are the assets there? These are things that can get so much more efficient. I mean, we're talking about T+5, T+1. I mean, obviously, with atomic settlement, that create, of course, different issues and challenges. But we are capable of moving leap years, forward in terms of how we look at things, how processes work, how much error there are in the systems, and how many times we repeat those errors in the system. So, for me, the sanctity of the data, the integrity of the data, and the sharing of the same data amongst everyone in the ecosystem is a massive benefit, which will cover the inefficiency that exists at a minute.
Don't you think? Oh, sorry.
Just, Steve, did you want to go first, and then we'll come to you, Carl?
Yeah, I mean, it's hard to pick out one inefficiency. I mean, there's so many. If I was to point to one which I think is really fixable, and it goes across all markets and all technology, it is actually just network connectivity. We deal with customers who spend weeks trying to open up firewall ports. And that is due
So you said weeks trying to open up file reports.
Yeah, and they can't, they can't open, and that can all be outsourced. I mean, basically, if you can either connect to a cloud infrastructure, whether it's physically hosted or virtually hosted, that vendor, I mean, obviously, it could be us, but there's lots of other people doing it, that removes a whole set of inefficiencies very, very quickly. And there's not much value add in that business. But most banks persist with doing it themselves for security reasons. Okay, and we, passionately believe if you run private circuits and you put things in a virtual cloud, or and it's ring fenced to that owner, that bank, or that asset manager, it's very secure. So I think that's a really easable, fixable problem, but it's not one that lots of people want to address. Right?
And I must add one point. I was earlier this week in a meeting with a large banks, which I will not name, of course, but we are still exchanging signed pieces of paper in brown envelopes to close processes in 2024.
Yeah.
One thing that, sorry, as you were talking earlier.
DocuSign is useful, by the way. Sorry, go on, Carl.
One thing you were saying earlier, I was thinking about that, or you're saying from primary to secondary, and one of the things that in my old world, capturing that data, and there's a hierarchy to this data, so you can capture public data, and that sort of sits at the bottom of the hierarchy. And then you can capture your own data, which sits at the very top of that hierarchy, and then you're able to assess it and analyze it, and you make better informed decisions. And I was just thinking about this. One of the inefficiencies is if you don't have standardized rails, and that could be the primary issuance rails that we've got, or it could be FICS, or whatever it happens to be, you're unable to capture that data. And if you can't capture that data, you can't analyze it, and you can't assess your own behavior, because humans are still involved in a lot of the stuff we do. Again, in my old world, we looked at this quite closely, and in my new world now, we're doing a lot around statistical modeling and around predictive analysis. And if you get the right hierarchy of data, predictive analysis is up to 85% accuracy. So again, those are the inefficiencies. Sorry, it was just that you jogged my mind, and I suddenly thought, it's the utilization of data. So whether it's TradFi or DeFi, it kind of doesn't matter. You just capture that data, and with DeFi, it's easier.
So thank you so much for the audience for the questions that you're sending in. We're going to get to them in a minute. One quick question. So we've kind of, talked about tokenized assets. We talked about brown envelopes. How do we go from, hopefully, from the envelopes to the digital world, not the other way? Who's going to drive that journey?
Well, Ernest Hemingway said about a friend of his, he went bankrupt very, very slowly and then very quickly, and that's what will happen. So there was a Swiss bond that was issued, I think it was about a year ago, and it was fully fungible between TradFi and DeFi. So, and you saw, in my old world, we were switching between it because we were messing around with digital keys, and then we were settling in the old way. So it will start to happen. Steve, I think you're right. I think regulators have a part to play, but they won't be leading the charge. If we think about MiFID I, for those that were alive then, MiFID I was essentially looking back of the advent of algorithmic traders as smart order routers. It was a bit of look-back regulatory text. So I actually think it's about I call this the holy trinity of the buy side, the sell side, and the vendors. They have to come together. They have to agree standards. And the lady who was on the panel before, Emma from JP Morgan, she talked about that, about at the moment in the DeFi space, there are not standards. But there have to be a way of either creating standards or you're able to link the different solutions together so it becomes standardized.
Any other thoughts on this? Or?
I'll pick up on that standardization bit because we talk about this in our office every day. So a good example of standardization in financial markets is FIX protocol. You know, obviously we're using that everywhere in FX and fixed income, etc. But we would describe FIX protocol as fix-ish. So it is better than proprietary protocols where we were, but every exchange or trading venue we talk to has their own version of FIX, and they're very long and very complicated. And FIX only tells you how the messages are going to come in. They don't actually tell you how the workflows are laid out and what the complexity of how you negotiate back and forth. So, so we would partly argue that having standards helps, okay, but what to get further along the process is you actually need to build automated testing frameworks. So I talked on this panel last year about how we do a lot of testing in-house, but one of our biggest frustrations is connecting to trading venues and the different, different standards of testing environments we have, because they are all different and they all want to deviate from the fixed standard to, differentiate their trading venue from others. But if you want to plug in and integrate with the trading venue quickly, you need test environments and you need screens where you can actually send yourself messages, etc., and check all the functionality. But you also need to do things like, we have our banks, need to do compliance testing. They need to simulate production world where they want to fire thousands of RFQs inbound from the venue through our systems and to their applications so they can test them end to end. And they need to do that under a heavy load, and they need to do it for an outright bond, and then they need to do it for list trades, etc. So you need to have, to help standardization, you need testing environments, and that's one of definitely the things that definitely gets overlooked quite a lot.
Okay, thank you so much for that, guys. We have plenty of questions, so we'll get cracking on them. First one we got was, how can broad adoption of DLT technology be achieved?
It's a close brother to the previous question. It can be achieved through standardization, through some brave people taking first steps and not succeeding in all of them. And, it's tempting at this point to plug some of my clients, but I will restrain that temptation. Because, this is a monumental task. So, like I said earlier, some people in the room will just wait for this to progress and engage with it when they can or when they want to. And some people want to be first to market. Why? Not because they necessarily have the killer app, okay? Nobody, like Carl said, is a holy trinity. Nobody has the killer app. But someone will strike close to the killer app. And that will put them in history as the person that had one of the pillar of foundations of this market moving to the next 50 years, which, of course, in turn means they will survive in the next 50 years. And so that's my take on it.
I mean, we all stand on the shoulders of giants, essentially, so everyone's work is predicated on someone else's. If you think about, I don't know, why is it in the UK we drive on the left? It's just that we decided to drive on the left, and that's fine. And the cars are all different, and what's in the lorries, lorries and cars, they're all different designs. And then what's carried in those lorries can be various different things, it doesn't matter, but the basic standards are there, and that was to your point. And it's about having those rails that, the information runs along. I think in terms of broad adoption, it's up to each individual to take the time and effort just to, 5–10% of your time, just to understand what these different web applications do. And I'm sure all the youngsters know all this back to front, but it's the idea of just spending a little bit of time of understanding as much as you can, and then thinking, how does that apply to my day-to-day? And, it's these little, as the waves come in, these bits of shingle just move, bits and bits and bits. And then you see this huge sea change, if that's not mixing my analogies. Anyway.
I don't know why they're driving on the left side bit, but the reason why Heathrow is where it is because the guy who was in charge of deciding where Heathrow was going to be, it's exactly halfway between his office and where he lived. So these things happen too. This is not all rational decisions, right? Next question we have, and I'm paraphrasing it a little bit. Are there any asset classes that are doing this transformation better and faster than the world of bonds, fixed income?
Well, I touched on this earlier. I mean, from my view, I think there's some really interesting, innovative stuff going on the private markets because there's not a huge creaking infrastructure that public markets have. I think also the other thing, and I kind of wanted to touch on this, and I'm not sure it exactly answers the question, but it's amazing how much the Bitcoin ETF has kind of gathered in such a short pace of time. That tells us something. I don't want to focus on crypto specifically, but just the idea that people want some exposure, and it's an extraordinary amount of money in, I can't remember how long it is, 5 months?
It's about 12, yeah, it's since January, and it's like $12 billion.
It's huge.
Yeah.
Grayscale took 10 years to get to 28 billion, and the BlackRock one took whatever it was, months to get to, I think it's 18 billion now. It's huge. So that tells us something about the mass adoption, and so, forget the crypto element to it, but just the idea of people leaning into the DeFi narrative.
Thank you. Question to Steve.
Can I just take
sure,
that same question? It's back to a point Carl made earlier. Technologically, distributed ledger technology exists in pretty good standard for most of you in the audience to use. The people I find do a better job are those that are able to imagine what the transformation looks like and are able to actually, do the detailed deep dive into what the processes of the future look like and are preempting and are working through these processes to embed the technology. Because technology, the benefits of the technology, nobody's doubting it, right? And we're talking about adoption. So who's best? Those who can imagine adoption and can influence people across that journey. So
that's a good point, thank you. Question to Steve. What are the potential challenges to automate fixed income secondary markets compared to equities and other products trading? All of that in 2 minutes, please.
Yeah, okay, I'll try and go in 2 minutes. So the reason, obviously I've had quite a good experience in seeing FX automate. Why fixed income is so different is fixed income is not one market, it is several sub-markets where you've got government bonds, corporate bonds, IRS, repos, and we can go on. And they are segmented also by geography. But then the real challenge becomes that because they are less commoditized instruments, we negotiate via RFQ protocols. And when I got into this business, I thought, well, I know what an RFQ is, but I didn't, because there are so many variations of essentially negotiation protocols. So even if you look at TradeWeb Euro Govies, you can trade a RFQ, you can do a request for market, you can do a click and trade, you can do a list trade. List trades can be in 3 types. You can do all or nothing, non-contingent, do a portfolio. So it goes, essentially there's process trades, like a market on close, and that is one trading venue, one asset class. And if you're going to automate, you need to map all the state transitions, and you need to take care of things like when a primary server goes down, how you're going to replicate where you are with everything. So if you're doing a trade at close and you've essentially negotiated a load of stuff and your primary server goes down, you've got to recover everything, okay, for your end of day closing price. So there's a lot of, the difference between sort of fixed income and the other asset classes is really this complexity, okay, and it's understanding and mapping all that, and that's the path. But so fixed income markets are slower to adopt these technologies, but it will come for the things we talked about earlier, namely competition. It's more efficient to trade in an automated fashion.
Do you think that because of this complexity, a leapfrog is more likely than a kind of gradual change?
So let's consider this. The average European equity trades 500 times a day. The average European fixed income across all the sub-asset classes, if you like, trades 1.5 times a day. And then if you think about the dispersion of that, you're going to get bonds that trade once every 6 months. So you're spot on. Fixed income is entirely different and has to be dealt with differently. And that's why I'm so strong about the utilisation of data. And that starts right with primary. So if you can capture all your timestamps as you're going for that primary issuance, the banks can capture it as well as the investors. Meld that with secondary data. You have got, and I talked about the hierarchy of data. That's so powerful. So actually, the variability of the trading elements that you can talk about, you can program that out actually, because I'm sorry to say this, and I am an ex-trader. You know, the most inefficient part of the whole process is the bag of skin sitting on the desk in front of the computer.
I will just pick up, one of the things that's really accelerated change, and a lot of our customers say, oh, we've got to do something. Sorry, I couldn't say that, should I? The reason for this is certainly when you look at credit markets, growth of open trading, all-to-all trading, in government markets, we're seeing a lot more use of algos on the buy side and use of these list trading, portfolio trading workflows. All that is driving a huge increase in ticket volumes. So we did some research for US credit markets, and a large dealer is receiving 25 to 30,000 RFQ requests a day. Okay, you can't do that manually. You have to automate that process.
But we saw that in the equity world, didn't we? I mean, if you go back to, let's think, 1990, 95, that sort of period when it was screen-based trading, it used to be block trading was the way to trade, and then it turned completely on its head, and the algos came in and it sliced it. That's essentially what's happening to a degree, actually. I'm thinking more about investment-grade credit, really. I mean, it's starting to leach out, but that's what's starting to happen. So you have to utilise technology, and then for me, that transference to DeFi will happen because people will demand it because they want to make more money. They can't hire 80-odd people. It will be forced on it. So it's a set trajectory. It's just the timeline is uncertain.
Thank you so much for the questions you sent in. We couldn't get to all of them, but I'm sure the guys will be happy to answer them during lunch, and if they're not, just corner them anyway. Just to close quickly, let's go down the panel. We'll start with Carl. What do you think is going to be the most significant upgrade or step towards a more digital or more automated market in the next 12 months?
Next 12 months. Okay, so I'd like to do this at two levels. The first one is the understanding that the industry has to work together. So everyone wants to make money, but unless at the top level they're understanding about standards, no one will benefit. No one will. So it's about the industry getting together and creating those standards at a broad level, not for everything. And the other side of it is the capture and the utilization of data, because that manifests itself in better outcomes for everyone. And I'm reflecting on my, what's good for that means the mums and dads, get a better outcome as well.
Thank you. Etay?
I think common language is the story of the next 12 months. Common language and standardization, to which the ICMA is making a sterling effort, to their credit. However, all the same time, the people who are active in pushing the big deals, the deals will become bigger, they'll become more liquid, more available. So the pessimists will have less and less excuses over the next 12 months to sit on the wall or do nothing or whatever they choose to do. So I think there's a very positive 12 to 18 months ahead of us.
I can't believe I'm going to say this. I'm going to go with a regulatory change. So, but there's some...
So disappointed. So disappointed.
But there is some regulation coming in January next year in the EU called DORA, Digital Operations Resiliency Act. And that says if you're a strategically important institution, you must guard against data center fires and particularly security, cyber hacks, and it's becoming more, and it's pretty scary stuff. You get all your stuff wiped off, and we've seen some industry examples of that happening. So that regulation forces strategically important institutions and their vendors, to basically consider, do they have resiliency and can they test it? And that actually gives an excuse for some banks well, let's try something innovative, let's do something different, because we can put it under this regulation. So I think that's, hopefully, in the next 12 months, will drive some change.
Well, thank you so much. If you're upset that we haven't mentioned AI, Carl actually did. He just called it something else. So, tick. I've been asked to tell you to go for lunch next, which is in the exhibition area, so please get it there. But before you do that, please join me in thanking this wonderful panel for their contributions.